That's it for the business update. We're going to move on to the guest speakers. And the first one is Izak Odendaal. He will be talking about the world in 2025 and beyond. A look into the global geopolitical and investment landscape. Izak is the chief investment strategist at Old Mutual Wealth, and it is his dream job because every day he gets to think about how economics, politics, and the markets intersect. He's married to Emma and is the proud father of 2 daughters. To distract him from the stresses of the investment world, Izak enjoys reading and playing the guitar. Izak Odendaal.
Thank you very much. So my challenge tonight is that I've got 20 minutes and there's a heck of a lot going on. So let's push through. All right, so obviously I was going to start here because I think this is what's really shaking the world at the moment. And the thing is, when Donald Trump won the election late last year, there was an expectation. Everyone knew that he was going to be noisy. Everyone knew that he would be, he's got his style, and we lived through his first term. But there was also an expectation that he would ultimately be good for American businesses, right? Because he is, at least he presents himself as being a pro-business, business-friendly, economic growth kind of guy. And so initially the markets responded quite positively to Donald Trump's election. However, since he's come into office, and remember the Americans have this weird system where they have an election in November, but then he only takes office late January. So there's this long period where, it's like a weird handover situation. But anyway, so since he's been in office, and it's only been since the 21st of January, it already feels like it should be much longer. But essentially what he's been doing is focusing very, very heavily on trade tariffs, right? And I think that's kind of the core of the concerns that you're seeing among investors, is because he's been threatening tariffs not only on America's strategic opponents, so China. Everyone expected that he would put tariffs on China, import tariffs on China. Not many people expected that he would go straight after Canada. Canada being America's closest ally physically, very, very close economic ties. I mean, Canada, America, and the US have been in a free trade area since 1994. So over the last 3 decades, those 3 economies have been stitched together very, very closely. Supply chains over those 3 economies run very, very tightly. I mean, you might have seen the stat already that a car that is sold in America will typically have crossed the border between Canada and Mexico 8 times, right? Because although the car might be assembled in Detroit, it uses engine parts that were made in Mexico, but then those engine parts travel to Canada, where they are put together into something bigger, and they go back to Mexico, and some more parts are added, and eventually, so it's back and forth and back and forth. And you can imagine if you put 25% tariffs on each of those kind of cross-border movements, it would be extremely disruptive. Now, a lot of people will say, well, there's a grand strategy behind all this, and he's using tariffs as a negotiating tool. Other people will say, no, what he actually wants to do is use tariffs as a means of raising revenue, because obviously tariffs is a tax, right? It's a tax that gets paid by the importer. Doesn't get paid by the exporter, by the way. Unlike he says, it gets paid by the importer. And so you can earn tax revenue from those tariffs, and then you can potentially cut income taxes on American households. So that's the other theory. But of course, these 2 things are contradictory, because if you're only using tariffs as a negotiating tactic, then you're not going to get the revenue, because presumably you're not going to keep those tariffs in place. So the bottom line is, anybody who starts a conversation with what Donald Trump wants to do is X, Y, Z, and you can make a very cogent and coherent argument about what you think Donald Trump wants to do, and what the implications are. But the reality is, we don't know. We don't know what if it's all tactics, like it was in his first term, or if it's all big strategy. We don't know, right? And so the net result is you have a picture like this, and this is an index that, as the name suggests, measures policy uncertainty. And it essentially it kind of trawls newspaper articles or just news articles. I think we say newspaper out of habit, but essentially it's news. It's not paper form anymore. But it trawls kind of articles and picks up on clues of uncertainty, right? And you can see it's never ever been this much. We simply don't know. We simply don't know what's coming next. Now the problem is, if you're running a big business, or even a small business, and you don't know what's coming next, I think the sensible response is to do nothing. For instance, a lot of people will argue, and even in South Africa there's an argument that we need more import tariffs to protect domestic industry. For instance, you know the story about the steel mill in KZN that's closing down. A lot of people say, no, we need import tariffs to protect that steel mill. Now, if you're an American business and you say, right, if there are going to be import tariffs, I can invest in my own factory because I'm not going to import the goods anymore. But you don't know, as an American business, whether those import tariffs will still be there 6 months from now. You will only make that investment if you are absolutely sure that this is a permanent arrangement. And so again, I think the rational response for a lot of businesses and a lot of consumers will be, let's just do nothing. Let's not expand, let's not hire, let's not make any big purchases right now, let's not extend ourselves financially, let's build up some cash buffers. That's the rational response. The problem, of course, is if everybody does that, perfectly rational at the level of the individual, but if everybody does that across the whole economy, you end up with a big decline in spending and an economic slowdown. Right? And so the markets have kind of been quite choppy the last couple of days, because I think that is a sense that people are getting now, is that the US economy, which was running quite strongly up until quite recently, could enter into a phase of slowing down. And again, it's not specifically because of anything that Trump has done, because most of these tariffs are not in force yet. Right? So nothing's actually changed physically on the ground. What has changed, of course, is that Elon Musk has been running around cutting people's jobs. I mean, that is also a source of uncertainty, but let's leave that aside. I mean, otherwise things have not really changed. But the expectation that things might change, might not change, could be choppy, I think creates a lot of uncertainty, and uncertainty is not a friend of the business community. Right, and I think part of the problem here is that you come off a period where, if you now turn to the stock market, the American market has done phenomenally well, right? So if you think about Trump's agenda of making America great again, the reality is it was actually doing pretty well. So in this chart you can see the green line there is the US equity index, the S&P 500. The rest of the world, so everything excluding the US, so Canada, Europe, Mexico, Japan, China, South Africa, everything else is that light green at the bottom. So you can see phenomenal outperformance of the US market. Lots of reasons for that. One of them is just because the US economy performed better. So there was no sense in which the US needed to be made great again. It really was already outperforming quite substantially. However, the problem now is that obviously as that line goes up, people's expectations improve. Everyone thinks life's great. Everyone thinks that all these great AI technologies are going to be transformative. Long story short, expectations are up here. Reality is going to be down here, maybe, we don't know. We don't know where reality ends up, but I'm pretty sure reality is going to end up being lower than where the expectations were. And that is typically where there's trouble in markets, right? And you can already see, if you can squint, because this is a long-term chart, but you can see the US market has actually been dipping down. Interestingly, the rest of the world has been picking up, right? Unusual. So despite the fact that, for instance, Canada is going to be hit hard by these tariffs, you've actually seen the Canadian market do a bit better. The European market has done very, very well, despite the fact that Trump, I was just reading my phone a few minutes ago, that Trump now talks about 200% tariffs on Europe. It's a crazy threat. But European markets done better. One of the reasons why is because, yes, Europe is now realized it needs to spend more money on its own defense, cannot rely on America for defense spending. But the other reason, of course, was expectations were so low. Right? After many, many years of underperformance and very slow growth, expectations kind of ratchet down. And again, same story, but in the reverse. If expectations are down here and reality is here, slightly better than expectations, that's actually very positive for markets. And I think we can think the same kind of story when we come to South Africa, where again, expectations have been very depressed. I mean, the gray line there is the JSE in dollars. Expectations very depressed. We just need reality to be not great, just needs to be better than expectations. If you can go from very bad to slightly bad, that's actually positive for markets. You don't have to go from very bad to good, just from very bad to less bad. Okay, I need to march on. One of the other questions is, up until quite recently, we thought this was the most powerful man in the world. This is Jerome Powell. He's the head of the Federal Reserve, the US Central Bank. Very, very difficult situation for him. Sorry, the reason why he's the most powerful man in the world is because, of course, he controls US interest rates. The whole world uses US dollars, and therefore, if you set the rate on, or the cost of US dollars, that ripples throughout the whole world. All right, so immensely powerful person. As you can see, global interest rates have been coming down. Those are a selection of countries. US is the sort of a thick black line at the top. Everyone's been coming down quite nicely. US hasn't come down quite as much just yet. One of the reasons why is because Jerome Powell says, well, if you're going to implement all these tariffs, potentially going to push up prices, potentially going to lead to inflation. So again, I think similarly, if you don't know what's going to happen, just do nothing. And so they haven't cut interest rates further. What we've seen in the last few days again is that expectation starting to shift. If the US growth outlook is going to come down a bit, then interest rate cuts come into play again. As US interest rates fall, tends to lead to a weaker dollar, right? Because the reason the dollar has been so strong and the rand has been so weak is, as you can see, how high US interest rates have been. They shot up to the highest levels in many, many years between 2022 and 2024. Okay, South Africa. We had the budget yesterday, the second attempt at the budget. So the question there on the slide is, what does the budget mean for you? And I think it's important to understand which you am I referring to, because there are two versions of you. There's the version of you that's a consumer, taxpayer. There's a version of you that's an investor. Right? All those funds that Craig showed had a bond allocation, had allocation to South African bonds, except the global fund, obviously, but the local funds had allocation to South African bonds. If you are an investor in South African bonds, you want higher taxes, right? Because that means that the government is going to borrow less. It means it's going to issue fewer bonds, less supply, price goes up, right? Less supply, same demand, price goes up. So that's what you want if you're an investor. Obviously, if you're a taxpayer, you don't want VAT to go up. You don't want the minister to not give you personal income tax relief. You don't want sin taxes to go up, etc. So again, what does it mean for you? It depends which version of you we're talking about. If I just think about the investment point of view, I think the important thing that came out of the budget is that there's a continued emphasis on what we call fiscal consolidation, which is a euphemism for just saying the government must borrow less, because we all know that government borrowing is too much. In fact, if I just flick through this chart very quickly, this is the amount that the government spends on interest as a share of revenue. So in other words, for every rand that SARS collects, we're spending 22 cents on interest payment. Okay? Like any household, if you borrow a lot, your interest bill goes up. If you borrow a lot at very high interest rates, your interest burden goes up even quicker, right? And one of the reasons we like investing in South African bonds is because the interest rates are high. But those same high interest rates means, you know, this debt compounds very quickly. And you can see it's increased dramatically over the last decade. And obviously, as that increases, it squeezes out other spending areas. Okay. That is a situation we need to fix. We need to get that line to stabilize and to start drifting lower. In other words, government needs to borrow less. One of the ways you can borrow less is to start raising taxes, hence the VAT increase. Obviously, the VAT increase is very contentious politically. No one wants their taxes to go up. Within the government of national unity, there is strong pushback. I don't think the parties disagree on the substance. I don't think they disagree on the sort of core idea behind the budget, which is number one, we need to get these debt levels under control. And number two, we need faster economic growth. Okay, because if your economy can grow faster, then the tax revenues come in organically, right? They come in by themselves. The reason why this interest burden fell so sharply from 2002 to 2008, it's partly because we had kind of improved discipline on the spending side, but also the economy was booming in that time. And so the tax revenue just kind of rolled in through the door. You didn't have to increase tax rates. In fact, Minister Manuel at the time was constantly cutting taxes because he could, because he didn't have to spend so much money on interest. So again, the key thing is about infrastructure, and I think the budget placed a very strong emphasis on infrastructure to facilitate stronger economic growth. We can maybe go into details later if there's time, but I think some very interesting things happening in the infrastructure space, mainly around getting private investors involved. Right, up until now, the government has basically monopolized infrastructure. Yes, I mean, there were private toll roads and kind of bits and pieces here and there, but essentially through Eskom, through Transnet, through the airports company, through PRASA, through the water boards, you monopolized infrastructure development in the country. And what's happening now is that across all those agencies, space is being created for private investors to come in. One of the things the minister has said is that he wants infrastructure to be an asset class. In other words, something that pension funds and investment funds can actually buy into. And I think that's very exciting in our world. Perhaps not in your world, but that's okay. We're different people. But it's exciting, because it's good for economic growth, and it's also good for returns. It's good for potentially for the kind of things that we can invest in. Okay, and then the fourth person, and it's not my fault that these are all men, by the way. It really isn't. The head of the European Central Bank is a French lady called Christine Lagarde. So we could have spoken about her, but there isn't time. So we're just speaking about these four gentlemen. Obviously, from our Reserve Bank's point of view, the question is, how do they respond to this global turmoil? And again, it also puts them in an uncertain position, because on the one hand, if you notice, their inflation is down 3%. Now, when I say that inflation is low, I mean, people never believe this. They say, how can you say that inflation is 3%? Because everything costs so much. But remember, inflation is just the rate of change over 12 months. We're literally just saying, how much have prices increased between February last year and February this year? And it's 3%. Right? But you can see that in the previous years, inflation was 7-8%. So obviously, if you say how much have prices increased between now and 5 years ago, the answer is 25%. So prices have gone up a lot over the last 5 years, but that rate of increase has now slowed down quite nicely. It's 3%. Obviously, the Reserve Bank has a 3 to 6% target. So if you just look at this picture, there's room for interest rate cuts. Yes, the VAT increase will push up inflation a little bit, but not dramatically. However, they are also keeping an eye on this very uncertain global environment. And for them, the worst case scenario is that you do end up at a point where, as I said right at the beginning, all these tariffs and all this uncertainty causes US interest rates to stop falling, and then that gap between South Africa and US interest rates is too narrow. That typically leads to capital going where interest returns are nicer, so they go to the US. Rand weakens, that's inflationary. So that's kind of Governor Kganyago's worst nightmare. He doesn't want the Rand to fall very sharply. So in the net result is that although I do think interest rates are going to come down a little bit more, they're basically going to end up more or less where they were before COVID, which is sort of around 7%. So if you have a home loan like me, that's a little bit of relief. If you're a pensioner and you're living off interest income, for instance, then I think interest rates are still relatively high. So it's kind of best of both worlds. Good for stimulating consumer spending, but also still reasonable investment returns from kind of short-term fixed income asset classes. So in summary, lots of global uncertainty. We don't know. That's the short answer. I mean, I can try and forecast, but I mean, I really would be thumb sucking. So let's not do that. In terms of South Africa, in terms of the budget, I mean, yes, the last minute cancellation was not a good look, but I think it's also something that we should accept is going to be part of coalition politics going forward, right? Lots of countries with coalition governments tend to have budget squabbles. In fact, you know, the Germans had an election 2 weeks ago. The reason they had an election is because at the end of last year, their coalition government fell apart because they couldn't agree on how to structure the budget. So I think this is going to be the reality going forward. It's just we were so used to the budget running like clockwork. And I think now it's just going to be a different environment. And this budget that was passed now is going to be quite heavily debated in Parliament. But I still think that they'll find a compromise. To put it slightly differently, I think the budget is going to end up being less of an event and more of a process. We're used to it being an event. I mean, Old Mutual has a massive gala dinner every night, every year when there's a budget speech. It got cancelled 3 weeks ago. It was held again last night, just here behind you. But yeah, I think we're going to have to get used to less focus on the day and maybe more on the process that follows the subsequent days of the tabling of the budget. Locally, if you combine lower interest rates, lower inflation, more infrastructure spending and so on, I think it's a much more positive outlook for the South African economy than we've become used to. Again, expectations low, things just need to improve a little bit, and I think our markets can perform quite nicely, but ultimately it is going to need cool heads. Nothing ever moves up in a straight line, not locally, not internationally. There's going to be lots of noise, there's going to be a lot of scary headlines, and I think, you know, that's why we have great financial advisors to partner with us, you know, as investors, because I think of the many things that Craig and his team do, that kind of just keeping you calm and keeping you centered in your investments, I think is absolutely crucially important. So yes, you're all in very good hands. Thank you.